Nice to have you with us here on Morning Markets. I'm John Oakman in for Amber Canwar on this Friday, and it does look like bank jitters are here to stay. The latest victim is German lender Deutsche Bank, seeing its stock take a big hit this morning after fresh worries about the health and safety of its business. We saw a spike in credit default swaps. Let's get some perspective on all of this. Joining us here in studio, James Callahan, an associate portfolio manager at Barometer Capital Management, and stateside Mike Regan, who is part of the hard-working markets team at Bloomberg News, where he serves as a senior markets editor at Bloomberg. Mike, I'll start with you just to set the stage for this worry that we're seeing this morning around Deutsche Bank. What can you tell us?
Well, yeah, John, it's a weird one because Deutsche Bank came out and called its Tier 2 subordinated bonds, which typically would be the type of thing that would give the market confidence that the bank is in good shape, able to redeem these bonds. But my colleague Cameron Kreis, I think, put it best. He wrote this morning that the street is basically on a seek and destroy mission against banks right now. And even though, this move from Deutsche Bank in many it rationally should be considered a vote of confidence by the bank in itself by being able to call these subordinated bonds, the market is just in such a very skeptical mood towards any financial big bank in the U.S. or in Europe that, and Deutsche Bank obviously having, a history of issues that I think people were hoping were resolved, that the bank was back on the upswing, but clearly not healthy enough to be able to dodge just this sort of broad-based skepticism towards banks, especially announcing something like this, again, that really should have been perceived as a vote of confidence by the bank, but not so in the equity market and not so in the credit default swap market, where the cost to insure Deutsche Bank's debt is up quite a bit today. So it really just gives you a sense of how skeptical and nervous investors are towards bank stocks, both in the U.S. and Europe.
And I should note, Germany's chancellor has weighed in on the matter, saying that Deutsche Bank is very profitable and there's no need for concern. But James Callahan, let's get your perspective. Would you agree with the assessment Mike just put forward here?
I would. I would also say that as if you were a Deutsche Bank equity holder, I would be, a bit reticent to hold it into the weekend with what happened on Credit Suisse last weekend. But that's been the message of the market. If you look over the last 15 years, Deutsche Bank's been in a downtrend. So, I mean, that's the message the price action has been sending.
So, Mike, I guess if we're trying to figure out that weekend jitter that James is talking about right now, I mean, we now have a little bit of history. The market is getting used to this. We spent 2 weekends ago wondering what the response to the Silicon Valley collapse would be. And then, to James's point, last weekend was all about UBS and Credit Suisse. I mean, are we getting a sense? Are you hearing from your Bloomberg colleagues that this is going to be a busy weekend as well?
Well, yeah, John, and any of us with a little gray hair, obviously remember a lot of wasted weekends in 2008 in that financial crisis, when so much government action can take place to try to, save these banks. I will say we've gotten some news just recently in the last half hour or so that is pretty significant. That is Janet Yellen, the U.S. Treasury Secretary, is convening a meeting of the Financial Stability Oversight Council. And what that is, it's a committee of the main U.S. Financial regulators, the Treasury Department, the FDIC, the Federal Reserve, and a few other agencies. That does appear to have helped stop the bleeding, at least in the U.S. bank stocks. Everyone's watching that KRX, the KBW Regional Bank Index. It was dipping pretty hard early in the session. It has bounced back to almost flat after that news. And First Republic, clearly at the center, eye of the hurricane here, that stock was down a little bit early in the session and pre-market. It's recovered a little bit too. So it does seem like the market, at least for the moment, now granted things change so quickly in this type of environment, but for the moment the market appears to be taking that is a good sign that Janet Yellen is convening this FSOC, the Financial Stability Oversight Council, for a meeting today, which might suggest we'll get some news over the weekend about further measures that the government might be willing to take to stop this issue from worsening.
James, Mike raises an interesting point about being in the market. The fact that you've got on the one hand people who are worried today, but as an investor, I'm sure you're thinking about the ups and downs every day. You're also thinking about where we might be headed. So how have you been thinking about being positioned in a market like this?
Of course. Well, it's been tough to own the regional banks for over a year now. But the biggest concern for us is what would happen with no support for regional banks and tightening lending standards. The impact on economic growth that could have would resonate through the entire market. So that's what we're concerned about. Properly functioning banking sector is crucial to the U.S. economy.
Does it ultimately influence where you are and aren't as an investor right now within sectors and that kind of stuff?
It absolutely does. And I think that the recent decrease in yields in the U.S. has suggested that bond market's saying that the Fed will likely step into support at some point this year, which has been interesting because a lot of the tech companies' longer duration assets have started to work a little bit better over the last few weeks based on that.
Yeah.
So we've adjusted our allocation slightly. It probably doesn't pay from a risk-reward perspective to be 100% invested right now. But, there's some money to be made in this market. There are some good stocks to own.
That's an interesting point, Mike Regan, the fact that you have seen technology stocks rallying, arguably in part because this idea that maybe the Fed has to reverse course on rates. The reversal on rates is not an inspiring one because I think it sends more of a message not that we're out of the inflation woods, but that we are entering a murky stretch for the economy. But you've seen that money nevertheless flow into tech because of that phenomenon. And I do want to get a sense from you, given that this week Jay Powell did stay pretty committed to more interest rate hikes. You could interpret some of what he said and make the argument that he didn't. But what does it say that the market is increasingly betting that the Fed's going to reverse course when Jay Powell had the opportunity to make that clear and didn't this week?
Well, I think it's crazy to say this, John, but the rate hike situation is almost a sideshow, I think, to a lot of investors compared to what the Fed is doing with its balance sheet. Obviously, hundreds of billions of dollars going back into the system out the discount window in loans to banks and through this facility that was set up by the FDIC to fund any banks that are struggling with deposit flight. So a lot of people just look binarily at that Fed balance sheet and they see it expanding again. I think the argument and the debate going on, though, is, well, expanding the balance sheet in this way via loans to banks, is that as bullish of a signal as quantitative easing was when the balance sheet was expanded by buying assets, buying treasuries and mortgage-backed securities? So, if you're just looking at that chart of the balance sheet going back up, I think it's instilling a lot of confidence in some investors. The joke is the money printer's on again. The money printer goes burr, as they say on Twitter. I think there's a big debate and discussion going on Wall Street, though, whether that's the right interpretation of the balance sheet at this time, because it's not the same as quantitative easing. These are short-term loans to banks. It's not the same as actually buying assets from banks and others. So I do think, though, that explains a lot of the resilience in the stock market is, regardless of what the path of interest rates is, the Fed is committing a lot of liquidity to the system, and that's in general viewed as a very good thing for risky assets. And
James Callahan, I want to bring you back into the conversation here because the Canadian stock market is now in negative territory on the year. The S&P 500, you referenced the outperformance of tech, is in positive territory this year. How should Canadian investors think about how Canada fits into this global turmoil story?
Yeah, I mean, it's always tough for Canadian investors when the financial sector doesn't do as well. So I think that it
got a lot of exposure to bank stocks and that kind of stuff. The TSX does.
Absolutely, and dividend growth has weakened as a factor in the last few weeks as well. So it may be time to look elsewhere.
Interesting. What are we hearing, Mike Regan, just about the biggest banks in the United States, which for the longest time were getting ready to do more shareholder-friendly stuff, and then immediately, when they could, decided to start doing that. And here we are now in a position where you have to wonder, the more lawmakers get into the mix here, the more whether or not they're going to be tightening the screws there. I guess that's one question, but the other question is whether the screws are tighter for the regional banks than they are for the money center banks.
Yeah, John, I think everybody is bracing for screws to get tightened across the board, especially for the non-SIB banks, globally systemically important banks. And in general, I think the mood is that everything that's happened, regardless of if the government is able to successfully stop the bleeding in the short term, there's going to be a lot of caution from bankers across the board about extending credit. Are we going to see a sort of a seizure in credit markets? We've already seen the investment grade bond market, not much issuance there. We've seen deals pulled in the leveraged loans space. So the worry is that bankers across the board will get so cautious, not only with their capital return to shareholders, dividends and buyback type of plans, but also just in extending credit. And that credit is so important for economic growth that drives earnings growth market wide. So that's a very big concern in the near term, is how these banks react. Will they sort of shut off the spigots of credit, and what the ripple effect will be on the economy and the market as well? The vibe is that banks are most likely going to be very cautious across the board in the wake of all these issues.
Okay, James Callahan, final word to you. You highlighted there are some pockets of opportunity out there. So even with every headline looking pretty gloomy, you're staying at the ready.
Absolutely. When you look at the price action, there are absolutely some good stocks to own. We've been trying to hold on to our winners, which can be hard to do, and that's what we're trying to do now.
Okay.